A couple weeks ago, I had a debate with a friend of mine who owns rental properties as his full-time job about which is a better investment, stocks or real estate. Now, I'm biased towards stocks because they've made up the majority of my $300,000 portfolio, so today we're going to compare the two to see which one comes out on top. Now, before we get into it, take 2 seconds, hit like and subscribe. It really helps push this video out to more people, but let's go. Now, out of respect for my friend's privacy, I'm just going to refer to him as Jack for the rest of this video. Let's start by breaking down Jack's disappointing experience with the stock market. Then we'll move on to his thoughts on real estate and then finally compare that to stocks. So Jack likes real estate for a couple of reasons. He likes cash flow, he likes leverage, and he likes control over his own investments. Meanwhile, I like stocks for pretty much the opposite reason. I like long-term compounding, I don't like using leverage, and I like really low maintenance investments. Now for Jack, control over his investments was one of the biggest reasons why he likes real estate, because he had tried making money in the stock market previously and failed. He'd done everything a beginner is supposed to do when you first start investing. He read books, listened to podcasts, dove into financial statements, and he looked at pretty much every one of Warren Buffett's philosophies for investing. However, there were a few mistakes that really jumped out to me when he was explaining what he had done in the past. Number one, he did not have a long-term mindset. So Jack went into the stock market and he gave himself 1 year to make money, otherwise he was going to try his hand at something else. And the problem with making a rule like that for yourself is that you pretty much give yourself a 50-50 chance on whether or not you're going to make money, because there's no telling what the stock market is going to do as a whole in a single year, and that's if you're following the index, not even individual stocks, which he was trying to do, so his odds were even worse. Which brings me to mistake number 2, in that he was cherry picking stocks. Now, he wasn't doing this in an irresponsible way. He was following all of Warren Buffett's main principles. So he was trying to find good companies with solid earnings, strong balance sheets, and really good positive future prospects. But again, the problem is there's no telling what a stock is going to do in a single year. And that's something that he learned early on, which moved him towards real estate. With stocks, he couldn't control his investment the way that he wanted to. And again, if you only give yourself a year to see the performance that you're looking for, you're probably going to fail and be disappointed as well. And this is also because stocks do not equal businesses. And this is something Warren Buffett talks about in all of his Berkshire Hathaway annual shareholder meetings. He says that stocks are not the same thing as the companies. What I mean is they're disconnected in the short term. In the long run, stock performance is directly tied to the earnings of the company or the profits, but in the short term, it's tied to expectations and emotions. That's why he moved over to real estate, because the value of the home is not tied to something as lofty as emotions, and therefore the price of the home doesn't fluctuate nearly as much as a stock does. And by the way, that's an idea that Ben Graham talked about a long time ago when he wrote The Intelligent Investor. It's what he calls Mr. Market. Plus, the value of homes are not on display 24/7 for us to check whenever we want. I mean, they technically are if you're checking Zillow and you just see the price is the same as it was last month, but really, they're not updated nearly as much as stocks are. Stocks are real time. Every single second you can see it change throughout the day. But with real estate, that's not the case, and I'll explain why that's actually a benefit in just a second. But first, let's talk about how Jack views leverage, because honestly, that's one of my personal biggest issues with real estate, is how much leverage you typically need, or at least how much leverage people usually use to buy up a ton of properties. So I asked him what his thoughts were on leverage, which is basically getting a loan to buy a house. His answer was that he would love to get into $50 million of debt if the banks would allow him to, which worried me at first, but he reassured me why this isn't as risky as it sounds. Now, my brain immediately went to 2008 because what can happen will happen, and I don't think it's wise to act like another global financial crisis is off the table. Is it probable? Not likely, although the way things have been going in 2025, who knows? But is it possible? Yes. Anything can happen in the world of investing, especially the bad stuff that nobody sees coming. In fact, they even have a name for this, and that's called a black swan event. And trust me, they happen a lot more than people expect them to or want them to. Now, when I asked Jack to expand on why he'd be willing to borrow as much money as possible from banks, honestly, his answer was a little bit better than what I've heard from everybody else. So he told me he understands the risk, but he's extremely picky on the investments that he chooses. And this is really a key point here. What he does is he will only buy properties if they are priced way below what he believes to be their actual value. So if you have a house on the market that he thinks is worth $200,000, but it's only selling for $140,000, that's something he'll seriously consider investing in. Otherwise, he's not going to choose it. Now, you might think, duh, doesn't everybody do that? No, they don't. Because it's really not that simple. You have to know what you're looking for, and in Jack's case, he has enough experience doing this where he can recognize if a home is worth buying or if it's worth passing on. Now, that's tough to do as a beginner because it's tough to see if a house is kind of trashy and beaten down or if it's actually worth fixing up and selling. Ultimately, a beginner can't see the potential past its current state, but Jack can. Now, again, this is an important concept to understand in the world of investing because it's called the margin of safety. Again, a lesson from the legendary investor Ben Graham, who taught Warren Buffett. A margin of safety just means buying something below its actual value so that even if it goes down in value, you're still safe from losing your investment. And this is what Jack uses to buy up a bunch of homes using leverage and not feeling that much risk for himself. Because if a recession were to hit and home prices drop, let's say 30%, he would still break even on that investment that we talked about. Now, 30% is a significant margin of safety, and it would definitely be a significant recession if that were to happen, and it would be really risky if he was forced to sell. But the nice thing about real estate is even if home values go down, as long as you're making payments to the bank or whoever loaned you the money, you're good. Typically, if you have a safe, long-term fixed rate loan, it's rare that a bank would step in and want to stop making money off of you. Now, what about cash flow for real estate? Because this is a huge thing in the world of rental properties, and I wanted to ask Jack what his thoughts were on it. Now, this is pretty typical. He loves cash flow because it brings in money to him every single month from multiple properties that he owns. In fact, he's done it so much over the past few years that it's allowed him to quit his full-time job making 6 figures and just run these rental properties. Now, this would be very difficult to do if you only had one property, so I wouldn't recommend just buying one and then quitting your job immediately because you're probably not going to have enough cash flow to do that. But for him specifically, he's at the point where his net profit from all his properties makes up for more than his salary, and so he's able to do this. Now, I also asked him why he doesn't service his debt, aka pay off the loan as soon as possible, and his answer was this: inflation. See, when you get a long-term fixed rate 20-year loan, you owe the bank a set amount every single month for that entire 20 years. So whatever that number is every single month, it's not going to increase, assuming fees and escrow aside. However, he can raise the rents every single year for the next 20 years so that he's making more and more profit every single month. So let's say he buys a property and he owes the bank $1,200 every single month for that property. He can rent it out for, let's say, $1,500 a month, and he'll get $300 of cash flow every single month. But over the next 20 years, he can raise rents every single year just a little bit to either keep up with inflation or slightly beat it. And by the end of the 20 years, he could probably charge something like $3,000 every single month for rent. Meanwhile, the bank still only wants $1,200 a month, so that's a profit of $1,800 versus $300 when he first started out. So in this scenario, inflation is on his side because the debt is getting cheaper and cheaper, and he's increasing rents to make more and more money. Not to mention the value of the home is most likely going to be appreciating over time, and so you get some money there as well. So that's Jack's perspective on why real estate has been a really good investment for him over the past few years versus stocks. But I wanted to compare that to the stock market to see which one is truly the better investment. So I'll break down the comparison in 5 different sections that I think are really important when I'm considering stocks versus real estate. Number 1 is inflation. Number 2 is cash flow. Number 3 is control. Then we'll talk leverage, and then finally risk. So let's start with inflation because we just wrapped that up on the real estate side. So in the stock market, the way that you can match inflation at least is by buying TIPS. TIPS stands for Treasury Inflation Protected Securities, and these basically protect your money from losing money to inflation by keeping up with it exactly. But if we compare that to real estate, the idea behind that is not just to match inflation, but ideally to beat it. Otherwise, nobody would do it because it would introduce way too much risk just to earn the long-term average inflation rate of 3.3%. And if you do it right, you can earn a lot more than that with real estate or stocks, so inflation really isn't an issue to worry about here. How about the cash flow argument? Why not just buy some dividend-paying stocks or dividend ETFs and get the same thing? For example, SCHD is one of the most popular dividend-paying ETFs in the world, and if you put the initial investment of $140,000, the same as that house example earlier, you'd get about $400 per month, and that could be growing tax-free in a Roth IRA account. Problem is, not everybody has just $140,000 lying around to be put into the stock market. And I don't know about you, but I've never asked a bank for a mortgage and then secretly put into a Roth IRA to make me money, which is probably illegal anyway, so I don't know, check that out for yourself. So my point is that it would take a lot of your own cash just to get the same monthly income from stocks. Plus, you might be thinking that if you earn $400 a month from HD in that example, that's a lot less than the $1,500 per month that we talked about in the property earlier, which is true, but after you're paying off the mortgage and you have other fees and whatnot, it probably comes out to roughly the same net profit. So comparing cash flow for real estate to stocks isn't exactly apples to apples in terms of opportunity cost. But what about the risk with cash flow? Now, we talked about how rental properties are a great way to earn some extra income every month, but I can't help but being skeptical in thinking that that is always the case. And that's probably because no landlord in history has ever had a 100% success rate with their tenants. Something is always going to break, something's always going to come up, tenants may be late with paying or they may not pay at all and they cause you months of headaches. Or you could even have vacancies for far longer than you anticipated, which leaves you with basically an extra mortgage to pay on top of whatever you're already paying to pay for the place that you live right now. So I think it can be a great source of cash flow, but I'm I'm not confident in saying that it is a guaranteed way to make extra money every single month. What about control over your investments? Is it better for stocks or is it better for real estate? Now, even though I'm a stocks guy, I personally think real estate wins in this category in terms of the ability to directly affect the investment outcome. What I mean is you can pour blood, sweat, and tears and a ton of time and money into your investment and really drive up the value of the home. And that certainly works, but with stocks and ETFs, that's not really the case. Sure, you could do countless hours of research, you could read through all of the quarterly and annual financial statements, you could understand the CEO's behavior, you could run reverse discounted cash flow models to understand if you're paying too much for the stock price or not. But at the end of the day, none of that directly affects your investment itself, meaning the stock doesn't care how much effort you put into research and all your valuation. At best, you can vote as a shareholder. On the other hand, the ability to control an investment may not always be a good thing. For example, with real estate, if you want to really improve the value of a property, you can spend hours and hours fixing it up yourself, or you can pay somebody else to do it. Either way, it's going to cost you money in terms of your time or somebody else's. So I'm not a huge fan of thinking that just because you have control over the investment means there's more room for potential gains. And perhaps this comes from endless research and evidence that in the stock market, this really isn't the case. See, in the world of stocks, where we have active managers and active retail traders and investors, we don't typically see that returns get better the more active you are. In fact, it's usually the opposite. The more active you are with your portfolio, the higher the likelihood that you're making devastating mistakes to compound growth and selling and trading out, paying extra fees, doing all this unnecessary work just to make less than the index itself. And this is because you're playing an incredibly complex and difficult game with the odds stacked against you, at least as a retail investor. So while you can directly affect the outcome of your investments, that doesn't mean that it's a guaranteed way of improving your returns. But because of the evidence I've seen in the stock market itself, and for the sake of this video, I'm gonna give the slight edge in this category to real estate. So how does leverage compare between the two? With real estate, you typically need leverage unless you have tons of cash just sitting around, like I mentioned before. And the people that do, and the people that love real estate, typically spread out all of that cash to buy more and more properties with more and more leverage. Because why would you put just all that money into a single property when you could have multiple, right? Now, stocks also have leverage in things called margin accounts, but typically the interest rate is like 13 or 14%. So it's probably not the best idea to use it. And if you do it right, you can make a lot of money, but me personally, I don't love using it because it's essentially debt at the end of the day. And debt introduces risk that I deem unnecessary for my life. I'm not in any rush to get rich quick. I'm not in any rush to lever up and buy as many investments as I possibly can, because I'm perfectly content taking the long-term approach and trusting the process of investing and compound interest. You can obviously do whatever you want because this isn't financial advice and this is purely my opinion, but that's kind of how I view it. Now, on the topic of leverage, as far as margin of safety goes, the price of a home can always drop way further than you expect it to. Now, 2008 might seem like a lifetime ago for some of us, but for others who lived through it or know financial history, these things can happen. Do I think it's going to happen soon? Again, I have no idea and nobody else knows either. But I hesitate to think that just because you buy something 20% below what you think the value is means that you're fully safe. Because number one, your valuation can be wrong, straight up. Just because you think it's valued at a 20% discount, maybe it's only 5% discounted. And number two, the market could crash 50%. Tenants could leave, you could be underwater on the loan, banks could seize the property to offload risk. You don't have control of any of this stuff. And that's why I'm not a fan of leverage. It's amazing on the way up, but it's horrible on the way down. And it not only introduces risk of small losses completely drowning you out and turning you upside down on your debt, but it also brings in risk from whoever lent you the money in the first place, which could be banks or other investors. If they can't handle a massive recession or a bear market the same way that you can, you're going down with them. So because of all those reasons, I'm giving stocks the slight edge in leverage, assuming you're just being a prudent long-term investor. And finally, let's talk about risk. This is the most important topic in the entire video, and it can get kind of tricky and there's tons of rabbit holes I can go down, but I want to keep it simple with just 2 points of risk that I think are really critical to consider. Number one is the risk of losing money. Historically, both stocks and real estate have done well if you've given yourself a long enough time horizon to invest in them. For example, stocks in the US have never had a negative rolling 20-year period since 1950. And with real estate, depending on where you are, it almost always goes up over time. However, if you lower your time horizon to just a single year, for example, whether it's stocks or real estate, there's really no telling what your investment outcome is going to be. Now, stock prices are definitely more volatile, so there's a good chance that after 1 year, the price is going to be a lot different than before, whereas real estate is probably going to be about the same. So I'll give real estate the slight edge in this category simply because it has lower volatility historically. Now, the second version of risk, which I think is the most important and absolutely crucial to consider, is the risk of opportunity cost. Now, this type of risk is one that people forget because it's not as obvious or as painful as losing money you already have. Opportunity cost is defined as the loss of potential gain from other alternatives when one alternative is chosen. In plain English, if you have two options, you can only pick one. The cost is not picking the other. So a non-investment example of this is marriage. If you marry person A, then you lose out on the chance to marry person B. So with an investment example, let's say that you have $20,000 and you can only buy real estate or only buy stocks. So if you bought stocks but real estate went up more, that's your opportunity cost. Similarly, if you buy real estate and stocks went up a lot more, what you missed out on making, what you could have made, is the risk of opportunity cost. It just doesn't hurt as much, and so we kind of tend to forget it, but that's why I like paying attention to this specific type of risk so much. It's incredibly important and difficult to identify, which is why it reminds me of the Mark Twain quote, "It's not what you don't know that gets you into trouble. It's what you know for certain that just ain't so." Both stocks and real estate carry their own type of risk of losing money and risk of opportunity cost, so there's really no clear winner in this category. Now, some honorable mentions that I didn't go into depth in this video is first liquidity. Now, stocks can be sold instantly, whereas real estate can take up to months to sell, especially in a downturn. Again, this can be good or bad because we know that the ability to buy or sell whenever we want isn't always the best for our portfolio. That's one of the reasons why so many people build their wealth through real estate, is because they can't really touch it whenever they want to. It's a lot harder to sell out at the bottom when everybody's panicking because you can't just open an app and click one button. The other one is tax advantages. Now, with real estate, you have depreciation, you have 1031 exchanges, and you can write off expenses. And with stocks, you have things like long-term capital gains in a taxable account, or you have things like a Roth IRA or Roth 401k. So both have their version of tax sheltering, and it really depends on your situation and your goals for your investments. So make sure to always do your own research and ask a tax professional if you need help in this specific area. So what's the final conclusion? Are stocks better, or is real estate? So in terms of inflation, this is going to be a tie between stocks and real estate. With cash flow, I'm giving the advantage to real estate just because you can always raise monthly rents. As far as control, real estate wins again because you can directly influence the property value. With leverage, even though stocks are a little bit better because you typically should not be using leverage, real estate technically does have a slight edge in this category. With risk of volatility, real estate wins again because the prices typically don't swing as much as stocks do. But with risk of opportunity cost, we have a tie because you can always miss out on gains buying something else. In terms of liquidity, stocks win in this category because you can instantly sell, even though, again, that may or may not be good. Tax advantages is a tie because both of them have their ways to do this. Maintenance and effort is something I touched on, but stocks are going to be a lot more passive and far less upkeep and a headache than real estate, so stocks win in this category. And then default risk, again, I'm going to give it to stocks because I'm assuming that you're not levered up in stocks, but with real estate, you almost always have leverage. So those are my thoughts on stocks versus real estate. Let me know in the comments below which one you think is a better investment. Also, I recently opened up some spots for one-on-one financial coaching if you need help with your personal finances. Otherwise, check out this video here where I break down the 100K blueprint, and I'll see you there. Peace.